Premium Media's Mining Weekly Online is speaking to Ben Magara, the CEO of Lonmin Platinum. Ben, there is an urgency around the consolidation of your business. There is a deal at play. What are the benefits of moving this forward quickly?
Martin, it is in the best interest of South Africa Incorporated that this transaction proceeds speedily in order to protect the majority of jobs at Lonmin. We've done all we can. We've worked hard on all the levers to make sure this business remains viable. But in the best interest of everybody, this transaction would ensure that we get all the synergy benefits that would come from what I think is an essential word, which is consolidation of the platinum industry in order to protect the majority of the jobs.
And what would those synergies be worth, and how do they come about?
These synergies, we have looked at it because of the firm boundaries that we have with Sibanye operations and Marikana operations, and also we have an underutilized processing capacity downstream at Lonmin. So if we were to top up with almost 450,000 platinum ounces from Sibanye's current operations to Lonmin's 650,000 platinum ounces, we'll have 1 million ounces coming out of Lonmin's downstream processing capacity. The mount boundaries of K3 shaft and Siphumelele from Sibanye and K3 from Lonmin are immediate capital benefits. So we are looking at about 1.5 to 1.6 billion rands a year to 2021 as soon as this deal is closed. And this will also help in mitigating some of the job losses that we've put on the table, which are likely to accelerate if Lonmin remains as a standalone.
But if it doesn't go ahead fast, what are the short-term uncertainties?
We continue to see the challenges with the rand, which is strengthening. The platinum prices remains low, and those are uncontrollables. What we have continued to prove to the world is a resilient workforce, is a resilient Lonmin, pulling every lever, like the metal lockup we've got, the smelter cleanup projects, the bulk tailings project, which is now coming in on board. It's commissioned and is now coming to steady state by the end of the year. All those levers are helping us improve and maintain our net cash position, but it's becoming more challenging as we require more capital and we have no opportunity to redeploy our employees to the new projects because of the constraints of capital. Our net cash position remains within the ballpark of the 69 million post the rights issue of 2015. So we had normalized net cash of $64 million as at end of March, and because of the smelter cleanup, that all would be coming through. So I'm really resolute that this Lonmin ship will continue to sail and will continue to make sure we make all the difficult and tough decisions with our unions, with government, to make sure we protect and save the majority of the jobs. We are doing a great job. Lonmin today is 10 months without a fatality. All other safety indicators are improving and continue to improve in the midst of anxiety on employees about this transaction and in the midst of all the restructuring we are doing. So I'm really proud of the Lonmin employees and how we continue to work together. Lenders have given us enough runway to the long stop date of end of February 2019. We've got to make sure the transaction is done as early as possible, and we're engaging with all our unions. We're jointly engaging with Sibanye-Stillwater, with our unions, the ministries, the government, everybody, to make sure everybody appreciates that the earlier we can get the synergies from a closed transaction, the more we may be able to save some of the jobs.
Why is this platinum price behaving so badly? What are your views on this big elephant in the room, that platinum price?
Martin, I think you're absolutely correct. The platinum price has been down and subdued for too long. It's one of the longest cycles I've seen in my 30 years mining career. And the price is normally an indicator of oversupply. So whatever the mathematics, the price tells you it's oversupplied. And the solution to overpricing, the solution to low prices is the low prices themselves, because supply has to then shrink. And the industry as a whole has been shrinking capex. Nobody's spending unnecessary capex. There's no growth prospects on aggregate, which means supply is slowly coming down And even if demand did not increase, that supply alone will create tension for the price. When is that tension coming? I guess that's where we could make money, but we don't. That's the challenge. The demand, as we see it, is that as much as there's electric vehicles, as much as there's diesel vehicles, the heavy-duty diesels are still growing, and the emission standards are still coming, and therefore that should still enhance. I think the efforts of the industry in jewelry development in China and India are helpful, but we're not spending enough there. Why? Because we don't have the disposable income to continue to do that. So I think it's a real wedge, but the prices are not helpful right now. Us as an industry and our automobile players and OEMs have to emphasize more about the benefits of platinum. If you want this world to be greener, platinum is useful. But unfortunately, in the current environment, when the perception is that it's going to continue to decline, until the fundamentals of demand and supply equation actually come into the picture, we are seeing these low prices. And hopefully that will only come when that tension is now physically felt between customers and suppliers.
I do think the decline in supplies is just not quick enough to cope with the demand shocks that we've seen over time. Because something else that tends to happen, as some of the quartile 4 producers and quartile 3 producers reduce supply like us, anyone in quartile 1 with the ability to produce more does that. You know, so you just don't see the supply coming off at that rate. I do think that, you know, South Africa as a country need to also think about this whole platinum question, because the country owns a whole lot of the world's resources of this metal. So I think it's a very national question as well, and not just a corporate question.
Most of the vehicles, especially in the US, are gasoline or petroleum vehicles, which tend to drive the palladium market. That's why one could talk about the doubling of the palladium price. Platinum is mainly in the diesel element, and the VW scandal has not been helpful as a sentiment to the market and the perception that there is oversupply. And as I said, until the real demand-supply fundamentals come through, we are possibly going to see this lax, because the above-ground stocks today are less than they were in 2008 when the platinum price went above the roof. So one needs to contextualize all those things. But unfortunately, the perception that no one needs it for now is unhelpful. Coming back to pure electric vehicles, they are indeed a disruptive issue. When you travel and you look at the massive factories to produce just 5,000 vehicles in terms of producing batteries, the amount of lithium and cobalt you need, I think the disruption is going to be less than we think. But this is a platinum miner speaking. Also, what's important about EVs is that not all EVs are an enemy to platinum. Pure electric vehicles are a pure enemy to platinum, but hybrid electric vehicles still require even a higher loading of platinum, because you still require your internal combustion engine, which will only kick in when your when your pure electrics stop, and when it kicks in at much higher revs, which means you actually need a lot more platinum to get the emissions down. So there are benefits to it, but the negative is the pure electrics. And I think that's the reality. Yes, the volumes of how those vehicles are coming in. On passenger vehicles, we have seen in Europe, Western Europe particularly, passenger vehicles have dropped from 55% market share to about 44% market share. I think it's possibly lower than 40 right now. But these are small vehicles. But the heavy duties are massively coming through with stronger emission standards. And I think those will give us even more benefits. As an industry, I think our efforts are driven around how do we make sure there's harmonization of these standards globally? And how do we make sure that this harmonization and the real driving conditions testing is done appropriately by independent bodies such that those who are not using appropriate measures to reduce emissions can have more platinum. Decisive action, as Lonmin has continuously shown with all its stakeholders, is critical. The oversupply is not going to go on until we take those very difficult short-term pains for long-term potential gain. And Lonmin has done this with a third rights issue where our shareholders gave us money. That's real sacrifice. Our lenders came on board. Our employees, as we said, we've already lost possibly 8,000 people to date. So those are all the short-term pains we have to take. If it moved quicker, I think it would be very helpful. I mean, it's not unfounded with our political and kind of public interest challenges that we have an election in 2019 in South Africa. All those issues, Lonmin does not have one vote. So I think, understandably, those bold and tough decisions need to be made collectively. But as an individual, Lonmin and its own stakeholders will continue to make these decisive actions because we know that there is upside, but the short-term pain has to be taken. And everybody must be decisive. As producers, as partners, as a country, I think there is an opportunity for a country to drive what I think is currently so sad that South Africa is paying customers to have its metal. That's what loss making means. So South Africa Incorporated is losing more by simply paying customers to have its own metal. The benefits of social projects that we're doing, the benefits of employment we have, is at risk. And Lonmin is saying this. 20,000 people have the potential to be preserved by this consolidation. We need everybody on board to tick on some bold decisions like that. Otherwise, we risk the whole 33,000 employees of Lonmin. And more, if you look at the industry. Because as the Chamber of Mines has shown and SFA has shown, at least 60% of this industry in South Africa is today loss-making. And that's not viable for anyone. Platinum pricing is creating long-term damage to an already ailing industry, which has sacrificed in excess of 26,000 employees in the last 5 years. And we continue to underinvest in our future. Our solid operational performance is demonstrated by a 5.8% increase in metal in conch platinum production. Our Generation 2 shafts have increased year on year by 6.4%. We continue to find levers, and I'm pleased with the successful commissioning that we began of the bulk tailings retreatment project. It is within budget and scope, and is also on time. It will contribute amongst the lowest cost PGM ounces that the group has had for the next 7 years. We remain net cash positive every quarter for the last 11 quarters. The capital constraints are driving job losses at Lonmin. And the solution to that is consolidation in our industry.
That was Creamer Media's Mining Weekly Online, speaking to Ben Magara, the CEO of Lonmin.